Welcome to another episode of Rich Dad Stockcast, the podcast designed for those who are serious about enhancing their financial education. I'm your host, Denney, and today we're diving into an essential and timely topic, mastering market timing. Do you like that, Andy? Well, before we get started, make sure that you like, subscribe, and leave your comments below. Your feedback is crucial in helping us to deliver the content that you want to hear. And don't forget to visit stockcastbonus.com for free access to powerful educational resources that can boost your financial knowledge. Joining us today is my friend, Rich Dad expert, Andy Tanner. Andy, welcome back to the show.
It's great to be here, Del. The last show we just recorded was really about a fundamental idea, fundamentals. This is, I can tell by your topic, we're going to be talking about some technicals. I can see it coming. And these are great. These are the first two pillars of investing is these two skills. So this is in the bullseye. This is in my wheelhouse. So I don't always feel confident on every topic you throw at me, but we're pretty confident today. So this is going to be a good one.
Good. Well, market timing. Let's talk about market timing. It's often considered, one of the most challenging aspects of investing. Obviously,
For sure.
People want to buy at the bottom, sell at the peak. But can you walk us through the key principles of market timing? How do you analyze market cycles? How do you understand economic indicators? How do you do the buy low, sell high thing? What is market timing to you?
So let's get this straight. You could argue, let's play devil's advocate against market timing for a minute, because that's we in the last podcast, we talked about the diversification myth, and it really, that one's an easy one to shoot down. That's a first round knockout. That's an easy one. Market timing is tough. It is a tough deal, and most people can't do it. Let's just say it flat out. Most people can't. Let's make an argument that perhaps the defining characteristic of stock market and real estate, economies for that matter, the defining characteristic could be their unpredictability. There are so many factors and so many things that play in. Even quant guys have to weigh and quantify so many different things and decide, what weight to give all these factors. But the truth of the matter is, I think we can put to bed the idea that market timing is something that can't be done, because it can. Now, with that said, when you're going to time the market, it's not so much about your ability to predict when you're right. It's about the ability to react when you're wrong and adjust. And so, a lot of people think market timing is about predicting the future. I don't think so. I think it's about reacting to when you were wrong about your prediction. And I think that's the bigger deal, in terms of your hedges. So there's a guy named Jim Simons who I've read his book a couple times. It's by Gregory Zuckman, who's a Wall Street Journal. He's a journalist, and he did a biography of one of the most fascinating men ever to be involved in investing, Jim Simons. He was a math guy, MIT grad in like 3 years, got his PhD. He's one of these brilliant guys. Went and taught at MIT, founded set up the Stony Brook Department of Mathematics, and won all these awards. So while he had one foot in academia, he had this itch to scratch. I think he was motivated by money for sure, but I think he was more motivated by trying to solve the problem of market timing. And he did. Buffett's, Berkshire Hathaway is probably a 20% a year type of average over time. They've lost 48% one year, and they've made over 100 another. But their average has been about 20%. Before fees, Simon's is about 66%. So he's tripled what Buffett does. That's not easy to do. Billions of dollars in a closed fund. They didn't allow other people in. And they use quantitative analysis to time things, to say we're in here, we're out here, we're picking this now, we're getting out of this now. And they were tremendously successful with AI, with high frequency trading. Most of the trading that goes on right now is done algorithmically, and it's done short term, which proves that it can be done. So is market timing a real thing, and can a person do it? I have friends that are better at it than I am, but I have a hybrid of how I do it. So maybe we can follow with that. But the basic thing is market timing is a thing, and it's not easy to do, but it's possible if that's what you want to learn to do.
Well, you tease us with the hybrid. So tell us your approach here. I'm kind of curious because I know AI is into the timing of it, and it's tough to beat AI. I'm
Well,
curious, what's your hybrid approach?
well, think about this. If you look at the options market, the options market exists for a reason. It's a valuable market, and it serves a real valuable purpose. It's important to have an options market. And the options market can provide two things. As a buyer of options, you can buy choices. Another word for option is choice. And you can buy guarantees from people, promises for people. So you can take the unknowns, and for a fee, you can turn them into knowns, right? For example, I could buy a put option and know for sure that I could sell at a certain price. And that's in stone now, right? I don't have to worry about the future because I know I can at least do that for a fee. Uh, as a seller of options, which is primarily what I like to do, is I've got to have some market timing there. And here's why: options expire. So there's no such thing. And if you define an investor as someone who owns a business and has invested money in a business that is a long-term thing, and a trader of someone who's only worried about the price in and out, there's no such thing as an options investor. There's no such thing, because every one of those options is going to be worthless guaranteed at expiration day. It's going to be worthless the day after expiration. All the money that was to be made in it has been made, and it died. It's expired. It's done. So if you're going to use options in any sense of the word, you're going to have to look at that expiration date and be able to, with some accuracy, determine what's going to happen, what's most likely to happen with that option between the time you trade it and the time it expires, and somewhere in between. So in that sense, if I'm ever going to be involved in the options market, particularly as a promiser, on the selling side of options, I've got to understand a little bit of timing. Now, with that said, Dell, is you've got to understand that you can predict a direction, which is really hard to do, and you can predict a range, which is really easy to do. And because I'm lazy and I'm not the brightest guy, I tend to choose predicting range. So I will time the market in terms of expiration date and a range more often than direction. And if it's directional, I'm worried about, I'm probably going to be the buyer of the option because I don't know the direction.
What do you mean
So
by
there,
range? As you're saying range for our everyday listener, what is range?
yeah. So let's say Apple's at, as of this recording, Apple's back up to 220 today. Okay. So, Buffett sold it right around this price, and so it's recovered without him. The buyers have sucked up his shares, and Apple is looking resilient today. It's all-time highs are within reach, right? It's ready to, they're within striking distance. So let's say that I were to tell you that let's do some timing. By the end of the month, I don't think Apple's going to be at 400. And by the end of the month, I don't think Apple's going bankrupt. So that's a pretty safe range. And if I had the opportunity to bet that it would be under 400 and above zero, and I can make money on that, I'd place that bet every single day, right? So let's narrow that range a little bit. I also believe that it's probably not going to hit 300, and it's probably not going to go down to 100. Now, that's more of a narrow range, but my confidence that it would be in that range is almost equal to the previous, scenario. And so as you begin to tighten that range of price of how high it could go or how low it might go, you can begin to play with some pretty solid statistics and standard deviations of the history of that. There's never a guarantee it stays in that range. Nuclear bomb hits us tomorrow, maybe Apple is out of business, right? But then we're all screwed. So, playing with ranges, you can actually do that and create scenarios where you can make money. And that's what covered call writing can be. Covered call writing is beautiful because they're promises I want to keep. I'll usually not be too greedy, and I'll say, look, I don't think it's going to get this high. I just don't think it is. And if it does, if it gets that high that fast, maybe I sell for a little bit. I can always buy it back. To turn down income that someone's willing to give me for a promise to sell at a really high price, That's tough money to pass up. It's like The Godfather. It gave me an offer I couldn't refuse. So market timing and learning technical analysis is as important for someone who looks at ranges as it is for someone who's trying to do directions. And technical analysis, I think there's 4 pillars of investing. I think number 1 is fundamentals. We want to own companies. We want to own assets. We don't want to trade them. We want to own businesses that make money and pay dividends. If we want to put a rocket booster on that, we want to have maybe some options activity. Well, there's your technical analysis. You have to have that, in my opinion, simply because options expire. You can't just be in them long term. You've got to look at where that thing is likely to be, and you've got to get good at that, right? Third pillar is cash flow. That's when we actually do things. Fundamentals is observing data. Technicals is observing data. Cash flow is where we act. Risk management is where we act. So we get our data, and then we position ourselves, and we protect ourselves. It's a pretty simple investing system, that 4 steps of 4 pillars. And when a person studies it, practices it, gets good at it, I think it's life-changing. So yeah, you can use technicals to help you for sure.
What technicals do we use? What technicals do you? I love the 4 pillars: the fundamentals, the technicals, cash flow, risk management. I guess really starting with buying. Let's say I'm new to the stock market. I'm looking at this market. I don't know if it's gonna go over like a roller coaster, if it's gonna go down. How do I know when to buy right now? Looking at this economy, looking at where things are going, inflation. How do I know if I'm making the right decision? Am I buying at the peak? Am I buying at the right time? How should I know when to buy?
Well, if you're talking about stocks, you're owning a company, so you want value. And it really doesn't matter where the market is. You could be up against all-time highs. Buffett has been buying, energy companies. There's a bank he's looked at. You can buy at any time, but what you're going to do is you're going to look for value. So when do you buy? You buy when there's value. So price is irrelevant in that as long as it's a value proposition, that's that's kind of stating the obvious, isn't it? If what I receive is worth what I'm paying for it, and it's a smart exchange, I'll pay what people might think is a relatively high price. Occidental Petroleum is a great example of a Warren Buffett mistake, and maybe we can talk about it when we get back from break, because understanding value investing is less about market timing and more about understanding the business, where a person who's a market timer is going to use things like technical indicators and more technical analysis. So as a fundamental investor, when it comes to stock, I'm using fundamentals. If you ask me when I'm going to buy an option or when I'm going to sell an option, that might be more of a technical question for me, if that makes sense. Maybe we can delve into that after the break.
Short commercial break, but listeners, don't go anywhere. When we return, Andy will reveal some secrets about how to actually implement what we've talked about, some of those technicals. So stay tuned.
So far, it's been great. I needed a source where I could really enrich my education through stocks. I didn't really have an avenue for it, and it's helped me a lot. The simplicity has really gotten me on the track to where I enjoy the learning, as well as it's really solidifying in my mind. And they're not just trying to sell you something, they really care about the people that are in the course, and they really do care about you and your personal goals, and what you want to do is to help you and your family and whatever your goals are in life through that. So it's really been great.
Welcome back to this episode of Rich Dad Stockcast. Again, our topic is mastering market timing. Now, before we get back to Andy, remember to like, subscribe, and leave your comments below. Your feedback helps us to bring you more of the content that you want to hear. And don't forget to visit stockcastbonus.com for free access to valuable educational resources to boost your financial knowledge. All right, so let's get back to our guest, Andy. Now, Andy, we've covered some, I'll call it foundational concepts. Let's talk about implementation. What are some practical steps that investors can take to time their investments, maximize their profits, minimize their losses?
Yeah.
What can we do?
Let's look in technical analysis, there's a whole field of study here, and it's a rough it's a rough place to study because I think there's a lot of misconception about market timing tools. There's some companies out there that they come up with a new formula or a new oscillator or whatever technical indicator you want to talk about. And there are many, many traders who are just looking for the holy grail of predicting the future. And I'm going to tell you that they really don't predict the future. So let's get that clear, that a technical analyst, those are really bad crystal balls. Not to get too jargony, but let's just look at, like Dr. Joe Lepel has a MACD. It's where moving averages come together and go apart. Well, all that really tells me is the stock has changed its direction and has some momentum, and that could end tomorrow. So it's a lot like looking at the speedometer in my car and saying, okay, where do you think it's going to go from here? It just tells me that I'm going a certain velocity and how hard it might be to stop if I slam on the brakes, or how hard it might be to go faster if I floor it, right? It really doesn't tell me how much faster I might go or when things might turn on a dime. But what they do is they help us understand the direction things are heading in and the momentum behind it. They do accurately depict those things. So one of the keys to market timing is, I think you got to have five numbers. You've got to have an entry point. You've got to have, very important, an exit point at a loss, small loss, and perhaps an exit point at a gain, or at least a target that you think you could get to. Maybe it overshoots the target. That'd be great. But you got to have a good idea of where you think this thing can go. And then you've got to have a risk number and a reward number. So those are 5 things: entry, exit, target, risk, and reward. And it's really the management of that risk and reward and the exits that are going to matter when you're wrong about your guess. And that's what it is. It's an educated guess. In the words of Deadpool, it's an educated wish, maybe. I don't know. But it's really true, right? You've got to have at least that down. Then you add options into the mix to protect you when you're wrong. That, I think, is where the secret sauce is if you're going to try to make a prediction, get really, really good. There's a book. You don't need to read it. If you want to, I'll give him a plug, by Jack Schwager. He's actually written 2 of them. A first edition, a second edition. It's the same book with different people. And what he did is it's called Market Wizards. And what he did is he found traders, and these are guys they're not Warren Buffett type guys. They're guys that actively try to buy low and sell high, or short high and buy back low, right? They're market timers. And what he found is he interviewed all these guys, and this is really important for our listeners, is that absolutely none of them were the same. And if I can make one really strong point, I said this on a podcast once, and I used a poor metaphor, so I'll try to avoid that because, man, I got piled on, is I metaphorically, symbolically said, there's many ways to heaven. And then I got a Bible lesson from everybody immediately. I meant that in the realm of trading, there are many different pathways to get a person to their financial goals. So that's how I should have said that before. But the fact of the matter is, there's a lot of ways to become wealthy in real estate, in asset class, stocks, business, commodities. There are so many pathways to get to your destination and to create your own, heaven here on earth. There's absolutely, and even within real estate, there are guys that, like Kenny McElroy, doesn't like to flip. I know a guy who flips 100 houses a year, and he's done that for 10 years straight and made, he's sitting on $1 billion worth of real estate as an investor as well. So there are many ways to heaven. And what I found is the same as Jack Schwager found. They have a system. They're not doing it arbitrarily. They find their system. They find what works for them, and they stick with it, and they don't vary with their discipline. And so the same is true with stocks. Some guys are really, really good with straddles and strangles, and some guys are really, really good with spread trading. Other guys are really good investors. Some guys, time the market in the Forex. That there's so many different ways to do it. But the one common thread that Jack found is they all had a system. They all had studied. They all were educated and good at what they were doing. the idea that a person become a market timer off a handful of stock tips and that it's an easy thing to do, that would be a freaking myth. Because the guys I know that are good at it, they've really dedicated. It's kind of like, how do we win an Olympic gold? It's coaching, it's hours, it's practice, it's sacrifice. There is not something for nothing. And that's probably where the Cashflow Academy could have been bigger than I decided to make it. Because if I braid a message like a donkey of here's something for nothing, here's something for nothing, like everyone else on social media, people will beat a path to your door. That's just human nature, to try to get in the Garden of Eden where you get everything for nothing and everything's good and nothing's bad, and fantasy land, right? Here, in reality, hard work and learning matters, and it gives great results and dividends. So if you want great results, get a great process, and that includes market timing. Whatever indicators you're going to use and get good at.
I love that. You talked about discipline. Discipline is key. Discipline is actually like the theme of my year. I've been trying to be more disciplined in everything I do. Right now I'm doing a program called 75 Hard, where every day I've got to do a certain workout regimen. I've got to read 10 pages, drink a gallon of water. There's certain disciplines that I have to do every day, right? My question for you is, if you had to do that for an investor, there were certain disciplines that they need to do this every day, regardless of market timing, what would those disciplines be?
Number one would be, I would learn something new every week, right? Now, whether I engage in that every day is optional, because in my week, my wife and I have a meeting generally on Sunday. If we miss, we have to have it on Monday or another day. But you're going to look at your week, and life does happen. But I would definitely want to learn something new every week. If you're not learning, you're sunk. AI knowledge, what's out there, is increasing too fast not to keep up with that. So you'll never get to a point, I think, where you say, okay, I'm going to graduate, I'm going to commence my life now and not learn anything new. So learning being number one. Number two, vigilance. I've been bit in days that I haven't checked on the children. In other words, I got to check in on the market. I went on a cruise once and decided not to mess with the market. I thought, I'm going to be fine, and I got killed. And I'm on it back before that internet on the cruise. So you don't have to day trade, but you got to check every single day. So you got to learn every day. You got to check every single day. Third is accounting. You've got to look at what you do week to week and say, what did I do last week? Was I successful? Was I not? Make an accounting and a recap of what I did. And then fourth, I'd say you've got to exercise some kind of discipline. You got to find an asset to buy every week if you can. Did I buy an asset this week? If you're buying an asset, an accumulating asset, 401ks don't count, in my opinion, because those are assets under Wall Street's management. You bought an asset for them, not you. But you want to buy assets every week. You want to learn every week, right? You want to be vigilant every day. You got to check the children every day. You got to care about it. And then you've got to give an accounting. And if you did those four things, I think you'd be great. And if it's market timing you want to do, it's exciting. It's fun. People love it. People that are good at it really, really do well, and they love doing it. So if you want to do market timing, start with the technical analysis course. And I said the same thing on a previous podcast. If you want to learn fundamentals, I can teach you, or someone else can. Doesn't matter to me. But the same thing is true with technicals. Is looking at a chart, understanding support, resistance, Bollinger Bands, Fibonacci retracements, all these fancy words, all this jargon. Learn the language. Learn the language of technical analysis. Learn, candles. Learn this stuff, and you'll be able to make better decisions as you hone in your system for success.
I love that. Now, final question for you. So we talked about knowing when to buy in and timing, when to sell. You mentioned that in the steps of mitigating your risk, knowing your numbers. Can you talk a little bit about that? Because to me, that could be relative. It could be, I guess when I hit a 20% loss, that's when I'll take the hit, or maybe to another person's 3%. Yeah. How do you mitigate risk in all this?
Might be a little granular, for our podcast, but I don't mind dipping into the, I always hear Robert in my head. He trained me so much, say, don't go small picture, keep it big picture. Because if people don't see the big picture, then they miss the big picture. But there is devils in the details. So, for example, I'll give you an example of how I might decide when to leave. And there's many ways I might decide. But if I want to do a little trading, and I'm not above doing that, let me reiterate, I'd rather invest than trade, but I'm not above, doing a little trade if I see something I like. The first thing I might decide on when to get out would not be by percentage, because that's arbitrary. You might do that, but I would probably start with something like an average true range, because every stock has a different personality, and some of them, like 20% is a lot of money to lose, because then you got to get a 40% run to get back to even. So for me, that'd be a lot to lose, and I'd want to pull the plug far before that. But if I look at an average true range, I'd look at it historically, say, how does Procter and Gamble trade as opposed to Tesla? The volatility in those stocks are vastly different. I certainly wouldn't want to have a flat rate of exit on all of those. So I might take an average true range, which says, how much does this stock wiggle every day on average? And if all of a sudden it starts wiggling more than that, I know something's different. I know something's wrong. I know things aren't as they were when I got into the trade. Might be time to get out, because there's some unknowns being brought to bear, new action, something's different about the stock than it was historically. So I might take an average true range and say, let's give it, 1.5 ATRs. Let's give it a little 50% more wiggle room, for an anomaly. But if it starts going crazy outside of that range, whatever I thought was going to happen isn't happening. There's something I'm unaware of. There's something that's changed that I couldn't have been aware of. This isn't a trade that's probably going to be the best for me to hold on to and work out with. And it's those types of mentalities. That's a very rudimentary example of a basic exit skill. And in concerning target, I can look at what traders have done with it before. I can't expect a 20% run, if I've never seen it in the stock before. If traders have never pushed it that way in the past, I'm really hoping for something that hasn't happened in the future. But I've seen it multiple times, and I know that investors get excited about that stock. Technical analysis is not. And notice that when I shift to this conversation of technicals, Del, I'm no longer talking about the company. I'm talking about the traders and how they behave. I'm studying idiots on Wall Street or brilliant guys on Wall Street, and I'm trying to see how they're thinking. And that's why it's more difficult. Fundamentals are really solid numbers. Technicals and figuring out what the market's thinking is a little tougher. But there are ways to clamp that down. There are ways to measure sentiment. The same way I can measure it with my wife. If I see, she's teary-eyed, I know something's wrong. If I see she's got hop in her step, I know things are doing right. There are measurements that are recognizable for sentiment. And when I see a chart, I see fear, I see greed, I see, you look at the VIX, I see the emotions of the traders. When I'm looking at fundamentals, I just see how a company's doing. And that's why I like having both, frankly. I lean towards fundamentals for investing, but as a trader, things like ATR, things like support and resistance, just even the basics can help a person with their timing.
Well, speaking of timing, we're at the end of our time. So,
awesome
Andy,
stuff.
What a great episode. Well, like I said, that's a wrap for this episode of Rich Dad Stockcast.
Yeah,
we hope
I just interrupt and say, one thing as a final thought, as I've thought about the podcast, I'm going to challenge everyone listening to raise their game, because I know what's coming in the markets. At least I think I know. There's some rough water, and as I look at guys that are smarter than me, they think there's rough water. So I'm just gonna say something. If you're interested enough in financial education to come to the Rich Dad channel and watch a podcast like this, I'm going to challenge you to up your game and begin to study. If I use a word or jargon that you're not familiar with, get on it and get in the club and get serious, and don't be a toe dipper in financial education. If you're serious enough to watch this podcast. I'll issue a personal challenge, because there could very well be a time where I'm going to say, now, remember back, so-and-so, when I challenged you to learn these things, what if you'd have done it? So if you don't know fundamentals well, and you don't know technicals well, and you're caught in the advice culture of just listening to this podcast and this podcast and on the periphery, I challenge you to break through and become a serious student, to where you are in serious study with chosen teachers on a weekly basis, and really up your game. If you're a true advocate of financial education, you believe it can bless your life, I challenge you to up your game. I say that with a little bit of fervor because of some of the technical things I see coming down in the market. I'm usually not a big of Chicken Little as people might think. I'm usually very much about buying stocks. Learn right now. It's an important time in your life. It's no sweat off me if you don't. It's not going to affect my life, but I would just say, as a person who advocates for financial education, get serious about it. So I didn't mean to cut you off, but that's how it's kind of speaking from the heart right there.
I love it. It makes me think of a quote that says, "It's better to be a warrior in a garden than a gardener in a war." And there's some thought to that with what's coming ahead. So be that warrior, get educated, go to stockcastbonus.com, understand the fundamentals, the technicals, so important. So anyways, if you've enjoyed this episode, please make sure that you like and subscribe and leave us a comment. Your feedback always helps us to improve and give you more of what you want to hear. Make sure you share it with your friends and family as well, to help them make better financial decisions too. Thanks for tuning in to the Rich Dad Stockcast. Until next time, get smart, get invested, and get control of your financial future. I'm Del Denney, and we'll see you on the next episode.
Thanks, Del.
This podcast is a presentation of Rich Dad Media Network.